Just to allay everyone's fears, we did not disappear. We just did something even more irresponsible for a markets podcast in the middle of a geopolitical conflict. We took spring break. So if you opened your app last week and panicked, don't worry. We were just trying to see whether the macro volatility actually respects school calendars. No, it does not. Still, it was good to take a quick breather before the macro world decided to light itself on fire again. But spring break is over. Bitcoin is currently trading above $75,000 again. MicroStrategy is buying. The U.S. Senate is back in session. And there's a naval blockade in the Strait of Hormuz. With all of that, let's try to make sense of it. And let's roll the intro. Welcome, everyone, back to the Coinbase Markets Podcast. I'm Dave DeWong, Global Head of Research here at Coinbase. And as always, I'm joined by Colin Basco, who works with me here in research. Just note that if anyone wants the charts or research behind some of what we're talking about here, please go to the Coinbase Institutional Research website or sign up to Coinbase One, and you will be getting that into your mailbox early. But let me start with a confession, because right now I have a really boring market view. And we actually just published this in our monthly outlook about a week ago. It will be going up on our research website today. But what I said was that we actually have a neutral view on the market in Q2. And I said that because I have little to no confidence that what I'm saying about the current trading regime at breakfast is going to have any relevance by dinner time. But, and this is a but, if you force me in a corner and you ask me if I were either bullish or bearish on the crypto markets right now, I'd probably say I'm bullish right now. But that is also a pretty loosely held view with almost zero confidence. And that's obviously not because I don't like the asset class. I absolutely do. I wouldn't be here if I didn't. But we're just in one of those regimes where the macro environment is very path dependent. You have events that are literally being negotiated by the hour. Like you have a major military operation, you have these blockades. Then you have flows that are fairly bifurcated. Like on the one side, you have very sticky institutional demand. But on the other, you have this risk-off rotation, redemptions in parts of the market. And for many asset classes, maybe not crypto in particular, positioning is very messy. There are growing fears of global recession. We just saw the IMF spring meetings that are being held today, that the IMF cut their 2026 global GDP growth forecast to 3.1%. And that assumes that the conflict in Iran is going to be fairly short-lived. And this is all before we even get into the idiosyncratic stuff that I mentioned in the monthly report. So directionally, I lean bullish on a long-term horizon because structurally, I think that you have the ETF channel, you have tokenization, you have major themes, broader shift towards non-sovereign assets that are still underpriced. But if you ask me, how much confidence do you actually have that Bitcoin is going to be higher for a week from now? The honest answer I have is I have no idea. So Colin, love to bring you in here. What do I got right? What do I got wrong? And do you feel any more confident in that than I do?
Yeah, so I think I'm just going to simplify my entire outlook into a pretty simple lens of looking at how everything is trading through the lens of how oil is trading. So I think the way to understand the market over the last few days is that the optimism around the renewed US-Iran talks has taken some of the immediate war premium out of the system, but it's not completely gone. So I think right now, markets are starting to price the possibility that diplomacy can de-escalate this before the April 22nd ceasefire deadline, which is why I think you're seeing some of the price action that you're seeing today. But I don't necessarily think that this is going to last for sure. I think it's more of an kind of 50-50 bet here in terms of what exactly will happen. But it does appear that markets are reading it more as a pressure tactic for the U.S. the whole U.S. blockade, rather than necessarily the start of an actual ground invasion. Now, the next question, though, is whether or not that softer oil backdrop is actually enough to fully change the Fed's calculus. And I still think that the answer is probably no. So I think the breakout possibility of Bitcoin above something like 100K could probably be less probable, but the breakout above 80K could be something that may happen, but it's still up in the airs because I think the latest labor data isn't necessarily what we want to see because it didn't give the Fed the kind of weakness that it would need to move quickly. So the timeline for the next Fed cut could be longer than what we expect. So what exactly did the latest labor data show? It essentially showed that non-farm payrolls came in at an extra 178K, which is way above expectations, which were just at 65K. So I think on the surface, that tells you that the labor market is still resilient enough that policymakers can still stay focused on that inflation potential tailwind as a consequence of still elevated oil prices. I think people are getting a little too excited just given the fact that oil prices did drop down to the low 90s. But you have to keep in mind that this still is the low 90s. It's not like back in 50s. So I think that the possibility for the renewed inflation to hit in the upcoming prints is still relatively high. That being said, I do think the labor market itself is weaker than what those headline numbers say. So if you look at the internals here, the labor force participation is still low enough at 62%. Wage growth also slowed down all the way down to 3.5% year over year. We're seeing a broader pattern of revisions, which keeps suggesting that the labor market is actually a lot weaker than what the initial headline prints would suggest. So I think in my view, the labor market is not necessarily weak enough to force imminent easing, but it's also not as strong as the headline numbers make it out to be because of the fact that the actual labor force participation is going down. Plus we have that additional, variable of artificial intelligence, displacing a lot of labor capital. So I think that's another component which is only going to continue to grow and potentially grow in an exponential curve. So from that perspective, I do think that the inflation component is still really large in the Fed's decision calculus, in which case oil would still be the primary lens and macro variable to be able to analyze any price movement in the majority of these risk assets. And from that perspective, I still look at it through a support and resistance key level perspective, in which case $100 does appear to be one of the very key levels here. You saw the rejection off of $100 just recently, which is why you're seeing the rally in a lot of risk assets, in my opinion, and also why you're seeing this rally in Bitcoin. I think that's going to be a key level. Also $90 on the downside. I think if oil is able to break below 90, then I think that you're going to be able to see risk assets rally even harder. And from that perspective, this still is just being able to play it systematically. So I agree with your view that you can't necessarily take a long-term view. But then again, that's always been my view. I don't really think that you can trade markets in a long-term view because I think markets are continuously dynamically evolving, in which case you have to be nimble in positions and be able to change your sort of view on the market within hours. So I think from that view, I think right now I'm bullish on Bitcoin and risk assets abroad. I think equities are also looking good, by the way. But that being said, I think it's all just going to be going back to how oil trades.
Yeah, and I think there's a broader theme that's going on. We mentioned it before. I think that the world's changing. I think the way people trade is changing. There was this headline that came out that about 500,000 tech jobs aren't there anymore, and I think that many of those people are maybe turned to trading, and there's other things kind of going on, but people are trading systematically a lot more than they were previously. I think that they're using AI to kind of build out trading models, and that's probably contributing to this move that we're seeing in terms of why the long only kind of traders are kind of making way for those systematic traders instead. But you had a really good point about markets kind of trading back on the oil side anyway, back down off that $100 back to the 90. I think today we're trading slightly under that, even though we've got this active U.S. blockade of Iranian ports, Iran threatening to retaliate or escalate if these exports are choked off. But people were pretty optimistic about the negotiations going into the weekend. And then, that shine was kind of taken off when it said that things had broken down somewhat. Personally, I mean, these things do not get done in 24 hours. I mean, we saw under the Obama administration, for example, like the negotiations to actually, turn off sanctions against Iran in order to have some recourse on nuclear, and Iran not kind of building out a weapons grade with the nuclear stockpile. I think that took a better part of 2 years. So, these things are not short. I think that probably people were too optimistic that things were going to turn around very quickly. I tend to think that these things are not easy and they're going to take a little bit longer. So, I mean, that's kind of what's holding things off here. But let's kind of go into the Bitcoin side of things, because you had a really good point. Bitcoin is outperforming the rest of the traditional, asset complex, equities, bonds, all those kinds of things. And I said this 3 weeks ago. I said that 4 weeks ago that that's all Bitcoin had to do was kind of like stay the course, outperform, and then the narratives would start to pick up. And I feel like that's kind of where we are right now. Like, are we entering a new regime? You kind of mentioned that we have this ability to kind of break out to like the 80 level. Does this kind of put us back into that 75 to 125,000 kind of range for Bitcoin again? Arguably, of course, that's a pretty wide range, but still a meaningful one if you're in the crypto space. And, do things like the kind of GAM positioning, those kind of things still matter? Are those kind of secondary at this point?
Yeah. So just touching really quickly on the last point about gamma positioning, in my personal opinion, I don't think that the volumes in options positioning in crypto are large enough to be able to sway actual price movement in crypto. I think a lot of people are still trading this systematically through support and resistance, which is why I think those levels have been very impactful in determining flows. But I don't necessarily think that the options positioning and gamma exposure is having the same effect. I don't think its track record has been particularly compelling versus just looking at support and resistance levels. So I think the main way to look at it would be primarily through the liquidity pivot point structure perspective and market structure, rather than indexing too much in terms of options positioning as a leading indicator for how Bitcoin will react. Now, in terms of the range perspective, I don't necessarily see 80 to like 125K as a guaranteed range. I think from here, it's just a really weird market where headlines are so impactful and oil is such a strong macroeconomic variable determining flows that I think from the way that I would trade this systematically would still be just going level to level rather than trading it like a huge range. The problem with trading a huge range is that by definition, it's a huge range, meaning that it won't necessarily hold. So some people, like when they, for example, like the way to trade this systematically from a range perspective would be once you break back into the old range, the expectation is that price would continue to the upper bound of the range. I don't think that's necessarily true. So I think it's possible that it could reject anywhere in between. So I don't think you can play it as a huge range play with high enough probability to end up being profitable. I think the better way to play it would be just level to level and be able to, stay relatively quick and nimble and reactive to positioning, because I don't think we're necessarily in the same environment as we were, in the big run up in 2025 or 2024, just given where we are macroeconomically. I think there's a lot of problems and pressures that will pressure liquidity, which used to be the strong leading indicator for Bitcoin, to be able to, ascertain that Bitcoin would rise or fall on a pretty decent lag, 3-month lag. That lag and that correlation with M2 liquidity has fallen significantly. So like the only macroeconomic variable that showed strong statistical significance in being a leading indicator on a long enough time horizon to allow us to provide longer term forecasts has completely fallen apart. So that's where I would be more cautious in being, positioning long term.
Yeah, and the other thing that you mentioned was that we have monetary policy to think about, and I think because of Iran, and people have been thinking about it from the lens of what's going to happen with energy prices. Obviously, that could have downstream effects on inflation. Not necessarily, by the way, like the same direction that everyone seems to universally believe, which is prices higher. Actually, the weird thing about energy is that it actually has short-term effects and long-term effects, but the other big issue is that the Senate reconvenes because they've been on break as well. And the Senate Bank Committee has a confirmation hearing scheduled for former Fed Governor Kevin Warsh to be the next chair. I think originally it was scheduled on April 16th, but now it seems to be pushed back next week. But we have Chair Powell's term expiring on May 15th. So what's been delaying things is that, of course, Powell's been under a probe. Some people have criticized that as being politically motivated, but, do we need to see the probe happen first before Warsh gets confirmed? Tillis is the one who seems to be holding the cards on this side of things. I mean, this, I think, is making things complicated from the monetary policy perspective, because I think once upon a time, I would have thought that given Warsh is coming in, I was much more confident that we were going to get a dovish leaning Fed. But given everything that we have now, from what you mentioned on the labor market to what's going on in Iran, like I'm not so sure anymore. And markets aren't pricing it either. I think markets have been pricing it in and out. It doesn't seem that those cuts are really going to be in there anymore. I think this is what's going to be really complicated from a macro lens. And this is also why I have more of a neutral view on just risk in general, but on crypto in particular, because I really don't know what's going to happen with the Fed. I don't know, Colin, anything that you think is meaningful that we need to be watching for no, not just confirmation hearing, but just, the Fed and macro at large?
Yeah, I don't necessarily think it's as impactful as a driver as like the other variables that we were talking about, like oil, for example. I don't really know whether or not it's going to really change people's expectations on how fast they can cut if the larger driver of potential oil impacting inflation, that I think is a significantly higher driver. So I really probably wouldn't index too much on it yet. I just think that if you were to break it down into like percentages, like 90% in my view is being driven by oil, and then maybe 10% from these other extraneous variables. But those other extraneous variables are not going to be the swing factors, in my opinion, for large changes in market structure for any of these assets.
Yeah, I don't disagree with that. I think it's becoming a pretty complicated topic, but certainly one that's being overwhelmed by the larger geopolitical developments that we've been getting. Let's shift gears a little bit and talk about MicroStrategy, or as it's been rebranded, Strategy. And that's the fact that it has been buying a lot of Bitcoin recently. We saw it buy clip on April 7th, another clip on April 13th. I think on April 13th, this was the largest purchase we've seen in MicroStrategy in some time. But what's even more interesting is that there are a few people who believe that MicroStrategy actually isn't moving the market all that much. There was an article that we're posting here, if you're watching this on YouTube, that suggests that MicroStrategy now accounts for only around 7% of gross inflows into Bitcoin. Despite the fact that Strategy holds around 780,000 Bitcoin, the argument is that the incremental impact they're having on the market is becoming lower and lower. I don't really think that's the case. I think that's kind of a myopic view. But Colin, let's kind of do a quick math on these numbers. First of all, could you frame this up for us? How do you think about this? Does this kind of argument make sense to you? And just kind of go from there.
Yeah. So I think liquidity is a key consideration in how exactly market flows are going to be moving price. So for example, a buyer can be, say, only 7% of gross inflows and still matter a lot at the margin, or they could be completely useless. So markets are not really priced off average monthly flow shares in some abstract way. Instead, they're actually priced by who is buying, who is selling, when are they doing it, on which venues are they doing it, and against how much available liquidity are they trading. So even if strategy is not the dominant force, that does not mean its buying has little or no impact on price. In fact, it's a ton of different variables that are going to be at play. And I think the weakest part of this piece that you have pulled up is that if people are watching this on YouTube, you can see the chart. It essentially just throws together a bunch of different metrics as if they're directly comparable measures of market pressure, which they're not. And it's essentially comparing Strategy's demand to things like long-term holder supply changes, revived old supply, minor issuance, realized cap drawdown, ETF inflows, or ETF open interest. But those are completely different metrics. They're not really applicable in the same way. Long-term holder supply changes can be useful, but they don't automatically mean that coins were sold. Ideally, for that metric, you would want to see exchange inflows picking up at the exact same pace as the long-term holder supply changes occur, because then that would imply that they're moving those coins to exchanges to sell. But even that is an assumption. On the revived old supply component, that just means that coins are moved, doesn't necessarily mean they're dumped. Minor issuance is just new supply. It doesn't really mean that every new mined coin is going to be sold off the bat. Oftentimes they're not. Realized cap drawdown is more of an on-chain valuation metric that actual dollars are leaving the market. Doesn't necessarily mean that it's offsetting any new debt buying. IBIT open interest is just an ETF. IBIT is just one of the biggest ETFs for Bitcoin. It's just a derivatives positioning measure, not really emblematic of direct spot flow. So I think in general that article is essentially building a big denominator out of things that are economically very different. And then acting like that proves that strategy has a small relative impact to the market in terms of pressure for price, which is not necessarily true. That denominator itself is very conceptually muddy because it says that strategy is 7% of gross inflows and 9% of net flows, but then it uses that mixed basket of on-chain variables, supply changes, ETF data, and derivatives metrics to just support that claim. But if you really want to argue that the single source of demand from MSCR is being overwhelmed, then you need to compare it against actual offsetting sell pressure or actual withdrawal of demand. And none of those metrics are direct measures of offsetting sell pressure or withdrawals of demand. So I think that's one problem. There's also the time horizon problem. We were discussing earlier, like the systematic approach of trading. A lot of these flows will happen based off of momentum trading at key levels. So what that means is that when you pull it back 30 days, so they're using a 30-day aggregation window to explain how the market is moving. You can't really do that. A lot of those flows will happen within a couple of hours or days, and then momentum will take over as key levels are broken. So that can often hide actual mechanisms, whereas just aggregating over a 30-day basis and completely ignoring momentum movements after key levels are broken kind of removes all of that. And a lot of the buying can also happen at very thin liquidity periods. So a lot of weekend buying can also be the start of huge trends and start of long momentum breakouts. So the fact that it's aggregating over a 30-day full basis completely ignores the fact that a lot of the key moves in the markets will happen within very short periods of time, in which case a large buyer buying a key breakout and causing that momentum move and that trending move is actually the most critical component in starting a new bull trend or starting a bear trend if they're selling off assets. So I just think the whole analysis is a complete mess because it just kind of reflects a misunderstanding of how markets move, especially markets that are completely dominated by momentum. Artemis just put out a pretty interesting quant piece that explains the momentum factor and how important it is in determining crypto returns. Encourage people to check it out, but essentially just very quick TLDR, momentum is like by far the strongest factor in crypto pricing.
Yeah, I completely agree with this. I think they're looking at one factor when there's really at least like three, if not more. I mean, like they only talk about flows, but there's flows. I mean, obviously it's simple. Who's buying, who's selling. Like there's also stock. There's a signaling that you're talking about, which is kind of contributing to like the momentum factor. And if you go to the next slide, like if you look at how like long-term holders, which I think is in one of their bigger kind of, contributors, like they mentioned that ETFs and long-term holders have completely distorted things. I mean, like that's not necessarily true because they're only looking at one side of the equation. They're looking at like, are long-term holders like relieving themselves of the Bitcoin they have? Or are they kind of holding in here? But they're not looking at whether that's actually hitting exchanges. And it hasn't been. Like, yes, the amount of long-term holders who have been like kind of net leaving positions has probably increased, but there's other reasons why that's been happening. And, we're not going to, I can't say too much about it, but we've definitely talked to that cohort before, you and I, Colin. And, we both know that like, okay, they're moving for other reasons. These are people who are maybe in Europe and they're dealing with a travel rule for the first time. They want to look at privacy. There's other factors that are contributing to some of those OGs and their position inside of Bitcoin that's not being reflected purely by the on-chain metrics of looking at whether their stack is like increasing or decreasing. So I think, as you also pointed out, the other big error that I just noticed is just that like they're basically looking at whether Bitcoin ticked up on the day that MicroStrategy announced a purchase, which beyond like kind of like the time lag issue, I mean, there's so many other things going on. Like it could be netting off against another position. You don't know what the contrapositive is of that move. Like Bitcoin could have been like, like weaker if it hadn't been for a MicroStrategy, for example. But you can't, it just doesn't work that way. Like that's not how stats work. So I feel like maybe a lot of this was just clickbait and we're kind of like glomming onto it in a way that they wanted us to because it kind of highlights their story. So, maybe like the eggs on our face, but it just bothers me because that's just not how structural demand works. I don't know. Anything else I'm missing on this, Colin?
No, I think we covered it pretty in depth there. But yeah, complete nonsense. I mean, it's kind of what you see in 99% of crypto research nowadays, but
Yeah. So, as far as it goes, I think that they are definitely not telling the whole story, but maybe that's the whole point. And maybe like they're trying to do this. And there's another thing that it really kind of bothers me as a point. And Colin, I would love for you to kind of get into it, because like something they did not recognize is that strategy is a float absorber. They don't sell their stockpile. They tend to like buy and hold. And that's something they didn't mention. Like, Colin, could you just kind of like unpack that for me?
yeah. So a float absorber is basically a persistent holder that can keep removing Bitcoin for more available trading supply, and that influences the market over time. It's not necessarily in that split second of time, but over time, if in each individual purchase, it won't necessarily create like some huge immediate candle, but it will continue to remove that asset from float. So in the case of strategy, Bitcoin buying, they're a very unlikely seller. So what it means is that they're holding more and more of that float. And that will make the available float for other people to buy continue to dwindle over time. So I think that is a pretty critical point that the article is also missing, that distinction between a float buyer versus a float absorber. I would characterize strategy more as a float absorber that is able to keep that supply under wraps for a longer period of time. So from that perspective, they definitely do have an impact on price, especially given the percentage of supply that they do hold.
Yeah, and I think that's what makes it difficult to really kind of pinpoint what percentage impact does a MicroStrategy purchase actually have on the larger Bitcoin market. I think that's something that a lot of people have a finger in the air kind of like estimate on these things, but trying to be more quantitative about it has been somewhat complicated. Although we're still going to give it a shot. Hopefully we'll see that kind of analysis in the weeks ahead. But before we wrap, let's spend a few minutes talking about altcoins, because a lot has happened under the surface, especially around Hyperliquid and Tau. Prior weeks, we've talked about how Hyperliquid has become kind of a weekend price discovery venue for things like oil, gold, equity. It has a perps market on these TradFi real world assets right now. And it's particularly meaningful when you see these geopolitical conflicts happen, TradFi is closed. But altcoin performance has increasingly clustered around these kind of like few high conviction narratives. And that I would include as like AI, perps, modularity, things like that. It's not really broad beta anymore. Colin, how are you thinking about the performance? Let's kind of start with Hyperliquid, given the current environment where you see BTC kind of diverging from the rest of the TradFi complex.
Yeah, so I think one of the biggest things, the biggest bull case that we wrote about for Hyperliquid was their HIP-3 market contracts. The ability to trade precious metal perps on the venue has been extremely important, I think, for Hyperliquid's competitive advantage. And especially just given on the weekend time periods or after the market closes. I think the CL USDC contract, for example, it's the oil contract, has been taking off like crazy. I think the price gaps on the weekends have been material enough to attract a ton of traders to want to be able to trade that perp. So they're moving their volume off of traditional contracts to being able to trade those on Hyperliquid. And as a consequence, you're seeing the volumes increase over time, even when the price ranges aren't as big. What that means is that per price change unit in the oil contract, they're attracting more volume over time. So that's pretty impressive. I think that's one of the major cases for why they've been able to get their token also to appreciate significantly, just given the fact that their model, the tokenomics of it is that they buy back a significant portion of the tokens based off of their revenue that they generate from trading volumes. And as a consequence, Hyperliquid is probably one of the strongest altcoins that we're seeing right now in terms of market structure. It's making new local highs here. So overall, I just think that it's been nice to see our research come true in terms of what we were saying was one of the major cases for Hyperliquid going forward. And the geopolitical scenario just continues to be able to support that move. So overall, pretty good execution, I'd say, across the board from the Hyperliquid team.
Another big paper that we recently wrote about was on AI. And here I would say that there have been some developments which unfortunately took place after our report, which may be affecting some of the price action. We saw a pretty big player, Covenant, actually step out and affect the price of Bittensor. Colin, could you kind of like walk us through what happened here? Why have the flows there been a little bit more reflexive? And how is this kind of weakening some of the perceived institutional sponsorship of Tau?
Yeah, so it's kind of unfortunate that this happened like a little bit over a week after we released our paper. Kind of impossible for us to predict, but I think my view now is that the Covenant's exit is a pretty real near-term negative for Tau sentiment, but I don't necessarily think it invalidates the broader case for decentralized AI, but it does negatively impact Tau token price. So what essentially happened was before Covenant 72B, for people that don't know, was a massive 72 billion parameter model that was trained decentralized across 20 different market participants with over 1 trillion tokens. And it was such a strong and powerful example of what decentralized AI could accomplish. And it all happened on Bittensor. So it was a very strong proof point for the token itself. But then Covenant departed from there because they were essentially angry about concentration. So they publicly said they were leaving because they believed that the control inside Bittensor remained too concentrated. And they were alleging punitive actions during that dispute. And now those are their allegations. And I don't think we can necessarily conclude either way, just given that it's not been independently verified. But at the same time, I do think that the drama itself, the ecosystem drama, is enough that the market is not just going to dismiss it off the bat, especially just given if you look at the price reaction during this entire Bitcoin rally. Tau didn't even move, which is not a good sign in terms of relative strength. From a price perspective, on a relative value basis, this looks pretty bad. And the bullish market structure has also been broken on lower timeframes. So from a purely systematic approach, it does appear that the Tau token is experiencing weakness from a market perspective. I think the key question going forward here is whether or not Bittensor can show that subnet development, capital allocation, and governance can continue credibly without large players like Covenant as part of their ecosystem, or has the perception just been too bad in terms of the centralization of that ecosystem? I think right now the founder has been pretty, the co-founder, I guess, has been pretty public in his statements saying that they're proposing a new locked staking mechanism, that they're proposing potential changes to be able to get ahead of this. So right now, I think the market just needs evidence that this is true and is not just fake sort of media. So I think now the key situation would be for them to rebuild that credibility through concrete changes. And from a market perspective, to practically play this, I think it would be safer to just wait for a bullish break in lower timeframe market structure rather than just trying to blindly DCA support at this point.
Yeah, I think there's a lot that still needs to be unpacked in the situation. And we're going to keep monitoring that alongside some of the macro developments we talked about on this call, developments in the Iran war, for example, what's going on with energy prices, how the ETF flows are evolving. Also next week, just to note, we are going to be introducing a new segment to this. So once a month, we're going to be talking about Coinbase Advanced. We're going to have some special guests on. So please watch out for that. And with that, everyone, thank you so much for tuning in to the Coinbase Markets Podcast. I'm Dave DeWong. If you have anything you ever want us to talk about, please hit us up on Twitter or some of the social media sites that we're on, and we will be back next week. Thank you so much.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.